The Safe Mortgage Loan Originator or MLO exam is a crucial step for aspiring mortgage professionals. This exam is designed to test your knowledge of mortgage lending practices, ethics, and relevant regulations. Among the most critical regulations you'll need to master is the Real Estate Settlement Procedures Act, commonly known as RESPA. Understanding RESPA is not just about passing an exam, it's about protecting borrowers and ensuring fairness in the mortgage industry. Passing the Safe MLO exam requires a thorough understanding of key legislation like RESPA. This act is designed to protect consumers from abusive practices in the real estate settlement process. The exam will rigorously test your knowledge of RESPA's provisions. By mastering the intricacies of RESPA, you demonstrate your commitment to ethical lending practices and consumer protection. Remember, as future mortgage professionals, you'll play a pivotal role in one of life's most significant financial transactions. Your understanding of RESPA can make a real difference in people's lives. By upholding its principles, you contribute to a fairer and more transparent mortgage market for everyone. This essay serves as a guide to navigating the complexities of RESPA, equipping you with the knowledge needed to ace your Safe MLO exam and excel in your mortgage career. The Real Estate Settlement Procedures Act, commonly known as RESPA, was enacted in 1974. It was a response to growing concerns about abusive practices in the real estate settlement process. Back then, the process was often shrouded in complexity, with hidden fees and a lack of transparency catching borrowers off guard. This lack of transparency made it difficult for borrowers to compare loan offers and understand the true costs associated with their mortgages. RESPA was created to address these issues head-on. Its primary aim was to protect consumers from unfair practices and ensure transparency in real estate closings. The Act mandates clear disclosures of all settlement costs. It also prohibits certain kickbacks and referral fees that could artificially inflate costs for borrowers. By requiring clear disclosures, RESPA empowers borrowers to make informed decisions about their mortgages. They can compare costs, shop for the best deals, and avoid being taken advantage of during the closing process. This transparency is fundamental to a fair and competitive mortgage market. RESPA has been instrumental in bringing clarity and fairness to the mortgage process. Understanding RESPA is crucial for passing the Safe Mortgage Loan Originator exam, as it ensures you are well-versed in consumer protection and transparency in the mortgage process. Before diving into the specifics of RESPA, it's important to understand the key players involved in a mortgage transaction. One such player is the mortgage broker. A mortgage broker acts as an intermediary between borrowers and lenders. They don't lend money directly but shop around on behalf of the borrower to find the best loan terms and interest rates. Think of a mortgage broker as a matchmaker for mortgages. They gather information about the borrower's financial situation, credit history, and desired loan terms. Then they present this information to multiple lenders to secure loan offers. The broker guides the borrower through the different loan options, explaining the terms and conditions of each offer. Once the borrower chooses a loan, the mortgage broker works with the lender to facilitate the loan approval and closing process. They act as a liaison, handling communication and paperwork between the borrower and the lender. In essence, they streamline the process, making it smoother for both parties. Understanding the role of mortgage brokers is essential because RESPA specifically addresses their activities. The Act prohibits certain practices by brokers, such as receiving unearned fees or kickbacks for steering borrowers to particular lenders. This ensures that brokers act in the best interests of the borrower, not their own financial gain. RESPA is a comprehensive piece of legislation that covers a wide range of settlement practices. It dictates rules for disclosures, prohibits certain fees, and outlines requirements for escrow accounts. One of the most crucial aspects of RESPA is its focus on disclosures. The Act mandates that lenders provide borrowers with timely and transparent information about the costs associated with their mortgage. These disclosures are not mere formalities. They are designed to empower borrowers. By understanding the true costs of their loans, borrowers can make informed decisions about whether to accept a particular loan offer. or explore other options. This transparency is at the heart of RESPA's mission to protect consumers. RESPA also strictly prohibits certain practices that could harm borrowers. For instance, the Act outlaws kickbacks and referral fees. These are payments made between settlement service providers such as lenders, real estate agents, or title companies for referring business to each other. These kickbacks and referral fees can artificially inflate the cost of settlement services for borrowers. RESPA aims to eliminate these conflicts of interest, ensuring that borrowers are not charged unnecessary fees simply because of agreements between service providers. By prohibiting these practices, RESPA promotes a more competitive and consumer-friendly marketplace. RESPA takes a strong stance against practices that could exploit borrowers or inflate closing costs. The Act identifies specific activities that are strictly forbidden in the mortgage lending process. For instance, requiring borrowers to use a particular title insurance provider as a condition of obtaining a loan is a clear violation of RESPA. This prohibition is in place to prevent tied selling arrangements, where borrowers are forced into using services they may not want or need. RESPA recognizes that borrowers should have the freedom to choose their own service providers, such as title companies, without being coerced by lenders. Similarly, RESPA prohibits lenders from charging excessive fees for services that are not actually rendered. This protects borrowers from being overcharged for services they never received. The Act aims to ensure that all fees charged during the closing process are reasonable and reflect the actual services provided. Furthermore, RESPA prohibits the practice of yield spread premiums. This refers to a fee paid by a lender to a mortgage broker for originating a loan at an interest rate above the par rate. This practice can be detrimental to borrowers because it incentivizes brokers to steer borrowers towards higher interest loans, even if they qualify for lower rates. While RESPA plays a crucial role in protecting consumers in the mortgage market, it's important to note that not all loans fall under its purview. The Act has a specific scope and applies only to certain types of mortgage loans. Primarily, RESPA covers loans that are secured by a federally related mortgage loan. This includes loans made by institutions regulated by federal agencies, such as banks and credit unions. It also encompasses loans insured by government entities like the Federal Housing Administration, or FHA, or guaranteed by the Department of Veterans Affairs, or VA. Essentially, if the loan has a connection to a federal program or a federally regulated lender, RESPA likely applies. However, there are exceptions to this rule. RESPA does not apply to certain types of loans, such as loans used for business or commercial purposes. Loans on vacant land, construction loans, and loans for agricultural purposes are also generally exempt from RESPA requirements. Understanding the scope of RESPA is crucial for aspiring MLOs. It ensures that you can accurately identify which transactions require compliance with RESPA's provisions. This knowledge is essential for protecting both yourself and your borrowers. RESPA's influence extends beyond the lender-borrower relationship. It encompasses a wide range of services that are typically involved in a real estate settlement or closing. These services, known as settlement services, are any services provided in connection with the origination, processing, or closing of a mortgage loan. The range of services covered by RESPA is extensive. It includes services provided by title companies, escrow agents, appraisers, inspectors, and insurance providers. Even services related to the preparation of loan documents, such as those provided by attorneys or document processing companies, fall under RESPA's umbrella. This broad reach underscores RESPA's commitment to transparency and consumer protection throughout the entire mortgage process. It recognizes that borrowers interact with various service providers during a real estate transaction, and it aims to ensure that these interactions are fair and free from abusive practices. By regulating settlement services, RESPA prevents kickbacks and referral fees between these providers, ensuring that borrowers are not overcharged. It also promotes competition in the market, allowing borrowers to choose providers who offer the best value for their money. Understanding the scope of settlement services covered by RESPA is essential for mortgage professionals to navigate the closing process ethically and compliantly. One of the cornerstones of RESPA is its emphasis on disclosures. The Act mandates that lenders provide borrowers with a series of disclosures at various stages of the mortgage process. These disclosures are not mere formalities. They are powerful tools designed to empower borrowers with the information they need to make informed decisions. At the very beginning of the loan application process, lenders are required to provide borrowers with a copy of the Your Home Loan Toolkit, a step-by-step guide booklet. This booklet, developed by the Consumer Financial Protection Bureau, or CFPB, provides borrowers with valuable information about the mortgage process, helping them understand their rights and responsibilities. Within 3 business days of receiving a complete loan application, lenders must provide borrowers with the loan estimate. This crucial document outlines the key terms of the mortgage loan, including the interest rate, monthly payment, and closing costs. The loan estimate allows borrowers to compare loan offers from different lenders and ensure they are comfortable with the terms before committing. As the closing date approaches, borrowers receive a closing disclosure at least 3 business days before closing. This document provides a final detailed breakdown of all closing costs, including loan fees, title insurance, government recording fees, and any other charges associated with the transaction. This final check ensures that borrowers are fully aware of all costs and have the opportunity to ask questions before finalizing their mortgage. Mastering the intricacies of RESPA is not merely about checking boxes for compliance. It's about understanding the spirit of the law and its profound impact on borrowers. By adhering to RESPA's provisions, you're not just following rules, you're actively contributing to a fairer and more transparent mortgage market. Remember, your role as a mortgage professional comes with a significant responsibility. You are guiding borrowers through one of the most significant financial transactions of their lives. By upholding the principles of RESPA, you're ensuring that they are treated fairly, protected from abusive practices, and empowered to make informed decisions. Your commitment to RESPA compliance is a testament to your professionalism and dedication to ethical lending practices. It demonstrates your understanding that a successful mortgage transaction is not just about closing deals, it's about empowering borrowers and fostering trust in the industry. As you prepare for the SAFE MLO exam, remember that your knowledge of RESPA is not just about passing an exam, it's about making a real difference in the lives of borrowers. By embracing the principles of transparency, fairness, and consumer protection, you're not only setting yourself up for success in your career, but also contributing to a more equitable and accessible housing market for all.